While signals from the Fed that the pace of U.S. rate hikes may begin to slow helped lift global markets today, but the rand and local bonds missed out as the Phala Phala report took center stage. And for more on markets reactions to the news, we're joined by Denker Capital's Kokkie Kooyman. Kokkie, thank you so much for talking to us this evening. Now, we did see the rand lose some ground today on the back of the Phala Phala report findings. How have local and international markets reacting to those findings? We did see the rand obviously lose some ground early on today.
Yeah, now the rand certainly initially started slowly, and then at one stage it lost 4.5%, which 4.5% in one day is quite a significant move on one day. It came back to about 2.6, 2.7% down, which is still a lot, but it's obviously still stronger than when it was, let's say, only a week ago. But that's because the dollar has been weak. You can see the rand's weakness against more the pound and the euro because the dollar has been weak. So the rand should have been strong. And all the other currencies gained 1.5% against the dollar, and the rand losing 2.5%, which means effectively it lost 4%. Our bonds also blew out 5%, and a good indicator normally for the market is your banking sector, which is very sensitive to economic swings, and the banks generally fell 9%. So with the currency falling, let's say 3%, that's a fall of 12% in dollar terms, which is actually quite significant. And essentially, markets will always react this way to uncertainty, but in this, the size of this fall is mainly because obviously the uncertainty is very big. And it's very important for the future of South Africa as to who will become the new president and what he will think in terms of, how the economy should be run, how the political party, the ANC, should be run, how, just in terms of his stance on ethics, on reform. So that uncertainty is really what's driven it.
Let's shift gears a little bit, Kokkie, and look at some company news that were out today. Talk a little bit about Murray & Roberts selling its entire investment in the Gautrain in a 1.3 billion rand deal. What drove that decision?
Yeah, Murray & Roberts have been a bit on the back foot. They've actually almost been forced by circumstances to do this due to the COVID shutdown. They're actually behind with a lot of projects, and as you know, often the projects are slow in paying, and so they're under a liquidity crisis, and so that means they just haven't got enough cash to do another big project like this, although they were awarded the tender. So I think they made the wise decision to rather sell it, make some profit, get cash in on that, and do the other projects and finish those. So it's sad that they were forced to do this, but I think it's just still the backlog from COVID.
And if we look across over to Sasol, the chemicals and energy group expects its first half headline profit to rise by more than 20% year on year, boosted by higher international oil prices and a weaker rand. But the group's SA operations, Kokkie, were disrupted in October and November. Can you tell us a little bit more about that and how it affected the company's bottom line?
Yeah, I can't tell you too much. I've been following all the banks and everything else, but essentially, Sasol should actually be benefiting from the higher oil price, although recently has been weaker. But on the year on year, it's still doing well, and obviously with the rand weakening as well. But you can see in terms of the share price being down quite sharply at one stage, 6 or 7%. Especially against the background of it earning a non-rand income. You can see the market didn't like what they said about the South African operations. So I think it's just the fact that, and I suppose we mustn't forget the impact of load shedding has on all large corporates, and it just means everything takes longer and is less profitable.
And let's close here, Kokkie, with, ABSA's manufacturing activity expanding, or ABSA's purchasing managers index showing a jump from October to November. Talk us through this and what this signals for the industry.
Yeah, so the last month's number was 48.2, and remember 50 is neutral, so 48.2 was actually means that we're reversing the manufacturing index, which is to be expected with the load shedding as it increased. And this month for November came out at 50, which is a marginal improvement. It's only slightly above the quarterly average of 49.6. So effectively, it highlights what we see everywhere when we're talking to companies. We actually saw all the bank CEOs 2 weeks ago, and everybody's reporting the same, that we just subpar. It's a very tough environment. Higher interest rates, higher fuel costs is really biting everybody, and business is afraid to commit capital, and that is reflected in a 50-49 score. So it's marginally better than last month, but nothing to really shout home about, to write home about.
I think let's leave it there, Kokkie. Thank you so much for your time this evening.